Good morning, everybody. My name is Nicholas Iftemi, and I'm here to talk today about a Granger analysis of volatility and the effective federal funds rate. First, we're going to start off with an introduction, later dive into the data selection process and talk about the model. Finally, we'll end on the results, conclusions, and suggestions for further research. The importance of the federal funds rate is widely known amongst scholars and economists. The federal funds rate dictates base interest rates for most American transactions. Everything from credit card debt APRs to mortgage rates are pegged to the federal funds rate. The LIBOR used to also be a standard, however, after the scandal, it was no longer used widely, and now worldwide, the federal funds rate is regarded as the standard for a risk-free interest rate. The federal funds rate is a proxy for economic health of the nation. Dips in the federal funds rate typically indicate a need for liquidity in the market, which can be indicative of economic instability. We've seen this during the 2008 financial crisis. We saw it during the dot-com bubble in 2001, and we're seeing it now again with the 2020 coronavirus crisis. Conversely, increases in the federal funds rate point to economic stability and a need to decrease inflation. Predicting the federal funds rate. Economic indicators have historically been used in an attempt to predict the direction of the federal funds rate. However, unemployment rate, inflation rate, and other industrial production indexes are typically indicators that have been used in order to determine the federal funds rate direction and magnitude. The problem with these models, however, is that in times of economic stability, these values explain low correlations and changes in the federal funds rate. The reason for this is likely the fact that inflation rate and unemployment tend to stay pretty stagnant and thus aren't correlated to changes during times of economic peace. However, during times of high economic turbulence, there's a strong correlation between the unemployment and inflation rates with regards to the federal funds rate. The Volatility Index is going to be the proxy that I use in order to ensure statistical significance. So the Volatility Index, or VIX for short, is a measure of fear in the market over the next 30 days. Specifically, the value of the VIX represents the size of one standard deviation in the S&P 500 index. Thus, a VIX value of 35 means that there's a 66.7% chance, one standard deviation, that the S&P 500 index will trade plus or minus 35% over the next 30 days. During periods of economic instability, the VIX increases drastically. Conversely, during periods of calm yield low VIX values. And so during 2008, 2020, we've seen massive spikes in the VIX. Currently, it sits at around 50, but at its peak, it reached 80, meaning that 80%, plus or minus 80% trading in the S&P 500 was only one standard deviation away from expected values. This, in turn, means that volatility was extremely high, and interest rates, as a result of that, dropped. Next, I'm going to talk a bit about the foundation for which my analysis is based on. Granger in 1969 wrote his seminal piece that provided the Granger test, and it provides an overview of time series analysis, including relevant hypothesis tests. Kalman in 1960 provided his seminal work and created the Kalman filter, which provides an alternative framework for time series analysis and provides a basis for comparison to our Granger example that we're going to be using. Boshnikov in 2011 had a basis for understanding of first and second order dynamic regression models, which we're going to use at the end of this to determine whether or not VIX is a statistically significant predictor of future federal funds rate. Now, my objective and means. My goal is to test if changes in the volatility index preceding a federal funds rate announcement are a statistically significant predictor of the federal funds rate. Specifically, do increases in the VIX cause decreases in the federal funds rate? This is what we'd expect, the inverse correlation. Employing the statistical software R, I use a Granger Causality test and a dynamic regression in conjunction with time series panel data to determine whether or not correlation and prediction can be assumed. The test is going to consist of two parts. First, I determine if there is a Granger causality between lag VIX and changes in the federal funds rate. And second, I will apply it in a dynamic linear model to determine if any predictive power can be assumed. Now we're going to jump into the data analysis. How did we come up with the data, and basic graphs about the data? What is it showing? What is it explaining? And are there any visual connections we can make? To start off, the data assimilation started February of 1990 and went until March of 2020 for both variables, or all variables. The Federal Reserve Economic Data website, the FRED, was used to compile federal funds rate, unemployment data, inflation rates, and industry production data from 1990 until present. Data was compiled on a monthly basis with no values excluded. The Volatility Index was compiled from the Chicago Board of Options Exchange, which provides the data and is the compiler and does all the calculations for the VIX. Data is compiled on a monthly basis with no values excluded from February 1st, 1990 to March 1st, 2020. So basically, we're going to be calculating this on a monthly basis. Remember that the VIX is also calculated on a monthly basis and predicts fear for the next 30 days, meaning that one observation period is the prediction of the VIX. Statistical summary of relevant variables. As we can see here in the summary data, it displays a little bit of right skew in most of the variables, meaning that over time, they're generally increasing. The VIX has been increasing, only has a interquartile range of about 10 points, which indicates that there's been relatively low economic turbulence over the last 30 years. We know this to not necessarily be true, but I guess what we can extrapolate from this is that periods of high VIX were short-lived, and generally economic calm was the norm. The minimum was 0.95, the maximum was 60, but keep in mind that within these monthly periods, the VIX spiked massively. I mean, we saw values of 80 in 2020, we saw values of 70 during the 2008 financial crisis. The federal funds rate averaged at about 2.41%, a median and a mean of 2.88%. Industrial Production Index, as we'll see in a few moments, has been increasing over the last 30-year period. Consumer Price Index has almost been a straight line. We saw that these values are increasing at the predicted 2% rate for the whole 30-year period. Finally, the unemployment rate has significant spikes in it, namely during the 2001 financial crisis and during the 2008 mortgage crisis. We saw unemployment rates spike to about 10%. And now in 2020, the data shows that we're reaching these levels again with the coronavirus scare. So here we can see a few of the plotted time series. I presented VIX, federal funds rate, industrial production index, consumer price index, and the unemployment rate side by side and plotted over the 30-year period. We see that by far the volatility index has the highest level of statistical noise, and we'll be addressing that during the Granger tests. In addition, we see unemployment rate spiking during 2010, the 2003 period, and during the early 1990s. Federal funds rate has generally been trending downwards with a long period where rates were extremely low between 2008 and 2016. Consumer price index is basically a straight line up. This reflects the relatively stagnant inflation that we have, and there's only one minor blimp at the 2008 financial crisis, but that was quickly corrected and has continued in a linear fashion. The industry production index dipped during 2008 notably, again during 2001, but outside of that, it seems like the industrial production index has been increasing significantly over this time period. Next, we're going to take a closer look at the VIX, and this is going to be our primary variable and the one that we're going to be analyzing most closely. The VIX standard deviation is plotted from 1990 to March 2020 on the bottom, and on the top, we see an overlay with the VIX value at that particular time. And so we're going to be focusing mostly here on the bottom graph because this is going to be the most important for us. We first want to note that the standard deviation of the VIX is highest during times of economic unrest. In 1997, when we saw massive scares in the Asian currency, we saw VIX increase. Investors were nervous. During 2001, we saw prolonged increases in VIX, primarily because of the technology boom and subsequent bust that happened in 2001, which created a lot of unemployment and caused trepidation in investors. 2008, we see by far the largest increase in VIX, and this was due to the coronavirus. This was due to the mortgage crisis that existed at the time. Next, during 2016 and 2012, we saw some trepidation surrounding the election cycle. These were relatively short-lived and didn't have significant increases in the VIX, although standard deviation increased. And finally, during 2020, we see a large increase in the standard deviation due to the coronavirus scare that we currently have. And this is going to be a significant factor in the model later on. Finally, on the data analysis side, we overlay the VIX and the federal funds rate to try to determine if we see any visual correlation. As I mentioned, there's a lot of statistical noise in the VIX, which is the blue line. and is plotted on the right-hand side y-axis. The federal funds rate is plotted on the left-hand side y-axis. But a lot of this noise is going to be eliminated when we input it into the Granger Causality test. What we can generally see here, though, is that during periods where the interest rate drops, namely 2008, 2001, and even in the early 1990s, VIX spikes in anticipation of those. And this leads us to believe that perhaps there is a chance for our hypothesis to be correct, specifically because the VIX is increasing so much in these preceding times. Now we're going to talk a bit about the statistical framework, the Granger Causality test, and the dynamic linear models. First, a note on Granger causation. Granger causation is an analysis that determines whether there is sufficient statistical evidence to determine that lag explanatory variable X Granger causes response variable Y. All computation is performed at the 5% significance level. The following formula is used to create an F value of the lag explanatory variable X on the response variable Y. Y of t is equal to basically two terms here, the first of which is an autoregression of previous or lag data on future data of the same variable. So in essence, our model here is going to be asking whether current values of the federal funds rate have any effect on future values of the federal funds rate. Next, the second term here is basically the heart of our analysis and what we're trying to figure out. We're trying to decide whether or not X, or lag VIX, has a statistically significant effect on future values of the federal funds rate. And so what we're hoping for here is that there is a statistically significant value that results from this equation. Next, we're going to talk a bit about the robustness check. So for the model to be robust, bidirectional causation and reverse causation, two of the most common forms of error, must first be accounted for. The same Granger causation test is performed, but except this time with Y being the lag explanatory variable and X being the response variable. And the goal here is to decide that this value is not statistically significant. Otherwise, we have this bidirectional causation, which is going to yield an insignificant result. And we can't prove Granger causation. The following formula is used to calculate the F value for this alternative or robustness check with the lag effect of Y on the future value of X. So basically, our terms here ask if the present value of VIX has any statistical effect on the future value of VIX, and whether or not the federal funds rate currently will have any effect on the future of the VIX. And we're hoping, again, that this term is going to be statistically insignificant. Finally, we need something to compare these F values to, and that's what we have the F-test statistic for. This is going to be the formula that we employ, essentially asking if the residual sum of squares is statistically different, or dividing the residual sum of squares by the second residual sum of squares, and trying to decide whether or not these values are greater or less than the F-test statistic. Next, we're going to jump into a few of the results and try to understand what all this data says. The results of the Granger Causality test, the first thing to go over are first the null hypothesis, second the alternative hypothesis. So, null hypothesis lag VIX is not a statistically significant determinant of the federal funds rate. Our alternative hypothesis is that lag VIX is a statistically significant determinant of the federal funds rate. And to determine that, we look at the data that we have here provided, and we analyze the two models. The first of which, lag VIX is related and correlated to future federal funds rate. This is our hypothesis, and this is basically what we're trying to test. And we see that at lag values 1, 2, and 3, it is statistically significant at the 5% levels. It is statistically significant at all lag levels. Next, we test whether or not the federal funds rate lag is correlated to the future VIX. Again, this was our robustness check to make sure that there isn't any bidirectional correlation. At lag values 1, 2, and 3, it is insignificant. Now, this is important. This essentially means that, as predicted, our lag VIX is a statistically significant determinant of federal funds rate in the future. The converse, however, is statistically insignificant, suggesting that our initial conclusion does not suffer from the bidirectional or reverse causation. Next, we're going to talk about a few of the additional checks that we must do in order to determine whether or not correlation exists between VIX and federal funds rate. Robustness checks have eliminated reverse causation and bidirectional causality, as potential causes of error. Two potential sources of error still remain, however: spurious correlation and latent confounders. To define these, it essentially means, is there other variables that could account for the difference that we're seeing in the federal funds rate? As in, is VIX still a statistically significant predictor of future federal funds rate, given other variables that might also have a relation? And so this is where we're going to input the CPI, the industrial production index that we talked about, and even the unemployment rate, and some of the other variables we talked about. In order to eliminate these potential sources of error, we use a regression model, but not a simple OLS regression will do. Instead, in order for it to be appropriate for a time series data, a dynamic regression model must be employed to determine if lag VIX is a statistically significant variable when other predictors are added. Keep in mind, a time series set or a time series panel data isn't going to have is going to have additional variables that need to be taken into account that a simple OLS can't do. So that's why we're going to be using this dynamic regression model. First, we start off with the inclusion of all the variables we talked about. The following regression model was tested to determine the significance of component variables in the predictive model. And what this equation is essentially saying is federal funds rate at some time in the future, t equals 1, is equal to the federal funds rate right now at the current time period, plus the VIX rate at the current time period, plus the industrial production index at the current time period, and the CPI and unemployment rates at the current time period as well. Note that the Fed is being calculated one observation period time in the future, t equals 1 or 1 month, and is based on regressions at the current time, in time 0. The results of the first dynamic regression model were successful. We see that the federal funds rate, volatility index, industrial production index, and consumer price index were all statistically significant contributors to this lag regression. Unemployment rate, however, was not. The variance inflation factor is a value that takes into account multicollinearity, and our goal here is to keep the values all under 10. We see that relatively consistently here in our first model, and we can make the reasonable conclusion that there is no multicollinearity present in the model. Our ANOVA value is 0.001, indicating that we have a statistically significant model with accurate predictive attributes, and our R squared is 0.9953, meaning that 99.53% of the variation in the federal funds rate can be attributed to the factors and to this model. While this was a good regression model, it wasn't perfect. We wanted to ensure that no statistical, that they're all contributing variables are statistically significant. This variable is, so from model 1, we proved that lag unemployment was statistically insignificant as a predictor of future federal funds rate. This variable then is removed for the second regression analysis, and this tests are rerun. The following is the regression model for the reevaluated regression model with the exclusion of the lag unemployment. Again, federal funds rate at time t equals 1 month in the future, is a result of the federal funds rate currently, the VIX currently, industrial production index currently, and the CPI currently. The results of the dynamic regression model 2 were slightly improved. The federal funds rate is significant along with the VIX, the industrial production index, and the consumer price index, meaning that at this point, all our regressors are statistically significant. The variance inflation factors are all within range, namely less than 10. Our ANOVA is 0.000, meaning that it is statistically significant and that we have a model that has attributes of predictive power. Finally, we have our R squared, which has stayed the same, explaining 99.53% of the variation. For the purposes of the future of this analysis, we're going to use this model because we want to ensure that all our regressors are statistically significant. So the takeaways: dynamic regression model 2 is slightly more performant than its predecessor. The model is a statistically significant predictor of future federal funds rate based on the ANOVA value. And the R squared indicates that the model explains, as I mentioned, 99.53% of the variance in future federal funds rate. Since VIX is still a statistically significant regressor in the dynamic model, checks for spurious correlation and latent confounders are fulfilled, meaning that we don't really have any sources of error present in our model or with the VIX correlation to the federal funds rate. As with any statistical model, there are limitations. The predictive power is merely driven by correlation and Granger causality. Financial markets are notoriously difficult to make any prediction with certainty. This is due to the statistical noise that exists, especially when you have actors that aren't always rational. Statistical noise confounds the true predictive models of any model. The federal funds rate is not governed by supply and demand or price discovery. Decisions are made by people instead of being informed by the markets, meaning that since these decisions are only made once every 6 weeks and don't fluctuate all that often, we are not seeing the same type of correlation or price discovery that we would see with other financial data, making it significantly more difficult to make any kind of true predictive model. Now, for our conclusions and suggestions for further research, we're first going to talk a little bit more about the limitations and hopefully some of the hope that we can glean from this analysis. Although correlation is not statistically powerful, in the financial markets it is, however, significant. Stocks tend to drop days in advance of poor earnings announcements. Bond pricing anticipates increases in interest rates days before realized hikes, meaning that there is some form of the strong efficient market hypothesis present, meaning that if you can correlate previous data or lagging data to future data, you're already ahead of other investors who might not be using the same kind of techniques that this investor is. A correlation in the financial markets is not negligible and can lead to profitable investment strategies. And so we see this a lot with technical analysis. We see many ETFs that are done solely on technical analysis and are extremely profitable. The reason for this is that despite fears of the strong efficient market hypothesis, there are signs that if you are able to interpret it correctly, you are making profitable strategies and profitable trades that can be better off in the future. The predictive power of the VIX. The dynamic regression model evaluated the coefficient of the VIX to be negative 0.00952. And while this value may seem small, you have to remember that the VIX can vary widely. A 30-point increase in the VIX would reduce the federal funds rate by 0.28%, meaning that when fear increases, and we see an additional 30% increase in the standard deviation of the S&P 500, the federal funds rate is likely to drop its target range window by approximately 0.25%, which happens to be the federal funds rate target window. The result matches the hypothesis. Increases in fear and volatility in the market prompt the Federal Reserve to lower interest rates and quell market trepidation. The next steps. The right additional regressors can reduce multicollinearity and increase the R squared that we have calculated. So if we add the right regressors in the future, perhaps some that are more statistically profound or are proprietary data, we might see a reduction in the value of multicollinearity and be able to explain more of the variation in the federal funds rate. Additional metrics of variance and volatility can be used to further investigate the correlation between volatility and the federal funds rate. Bollinger Bands, implied volatility, and average true range, ATR, are metrics of volatility that may have a statistically significant correlation to the federal funds rate. And in the future, future analysis can take this into account and see whether or not these technical indicators have any kind of correlation to the federal funds rate. Because if they do, with the conjunction of this model and another model that may incorporate these, may be able to better explain the effect of volatility on the federal funds rate. And with that said, I'd like to thank everyone for taking the time and listening to this. As I mentioned, I hope everyone's staying safe, and I look forward to seeing you guys in the future. Take care.